It's not a computer, but an old-fashioned panic that has sent the stock market plunging in the world's second largest economy. China's Shanghai exchange has fallen 31% in a month, despite emergency intervention by the communist government. Now there's a crisis of confidence in the market and in the leadership in Beijing. Seth Doane is our man in China. Seth, these Chinese markets were soaring far above rationality. So who's getting hurt now that the bubble has burst?
Well, more than 80% of investors here in China are small-time average Chinese, so-called mom and pop investors, many of whom got into a booming market. In fact, we saw more than 4 million new investors in the month of May alone. And the government here really has been working as a sort of cheerleader, encouraging people to get involved. Money has been relatively cheap, so people have borrowed heavily. And now that we're seeing stock prices start to slide, we're seeing some real panic selling.
And the Chinese government is taking extraordinary measures to try to stop this.
That's right. More than a third of the 2,800 companies on the country's two main stock indexes here have been forced to stop trading. And the government has set up a massive $19 billion stabilization fund to try to buy up some of those shares and shore up the market. It so far has not really worked, and that's creating fears here, not only among average Chinese, but also within the ranks of the Communist Party. This, of course, Scott, is a country that is used to having total control over its economy, a place certainly that prizes stability.
Seth Doane in Beijing at the start of another trading day there. Seth, thanks very much.